This is the Hey Ed YouTube channel, and I am your host, moderator, and all-around nice guy, Edwin Anderson. Okay, so I'm not a financial advisor. Don't construe anything that I mention in any of my videos as financial advice. Always do your own research before doing anything with your money. So today, I am going to continue my series called Trading Tricks, where I give you little tricks of the trade when it comes to trading. And today, we're going to talk about the 3 types of gaps in trading. So unlike my other videos where the lesson applies regardless of time frame, whether you're a day trader or whether you're position trading or whether you're even, heaven forbid, an investor. But this one, this is more specific to day trading. Okay, but it is an interesting point for you to know, and a lot of people aren't aware of what I'm going to tell you here. So, but a good trader is aware of this phenomenon. All right, so let me give you an example of what a gap is. You can see here that in this case, this line down here at the bottom, this represents the previous day's closing price. And then the stock opens up for the trading day at a higher price. And that creates what we call a gap. Okay, so again, what's happening when the stock gaps up or gaps down? Stock closes the previous day at a certain price, and then the following day, and is opening up at a price that is significantly higher than the closing price, or significantly lower than the closing price, and that creates a little gap. As a professional trader, I can actually trade in the aftermarket, right? That's a whole different topic for a whole different video. But for our purposes, for day trading purposes, we're talking about the opening price, gap ups, gap ups. So that's what a gap is. All right, and there are 3 types of gaps. The least common type of gap is what's referred to as a gap and fly. And that's pretty much what you would think it is, right? The stock gaps up and just goes for the rest of the day without having any kind of a pullback. Those are very rare type of gaps. In fact, it's been years since I've seen one. Back in the old .com craze, in the late 1990s. Okay, they were actually happening, quite often. Now, those kind of gaps are almost impossible to trade because you have no reference points to use as a stop or the entry. So the only way to trade that kind of a pattern is by guessing and hoping. And as you know, that's not a reliable strategy. So gap and flies for day trading purposes is really don't even bother. It's way too risky. If you're going to do that kind of thing, do it for a scalp, because you don't know until the end of the day whether it's going to keep on running up, right? Gap and flies, it's the least common gap pattern, and don't even bother. Okay, the second most common pattern is called the gap and consolidate. Now, this is what you would think it is. Stock gaps up and then goes sideways. For those of you who are familiar with my other videos, that's also referred to as the Anderson pattern. Yes, there it is, folks. So I told you I didn't invent that pattern. I just put my name to it because it's my favorite. The Anderson pattern refers to a stock that gaps up, runs up a little bit more, has a shallow pullback, goes into a channel. It is my particular favorite pattern to trade in general. So you might want to go back and watch my video on the Anderson pattern. And finally, the most common type of gap is what's called the gap and crap. And let's take a look at that chart that I showed you earlier. So here's an example of, I was looking around for, seeing if I could find some examples for you, and this is good enough. This is a pretty good one. Okay, so here's an example of a stock that gapped up on Friday. It went sideways for a little while, but then crapped. All right, this is the most common thing. Now, what usually happens with the gap and crap is it'll gap up and go down right away. But in this example, yeah, it went sideways for a little while, but then eventually it did crap out. This is the most common type of gap. Now, the way you would trade this guy is after it's had a little bit of time during the day. So you're going to need a little time, right? You don't want to trade it right away at the open unless you're going to fade it. You let it put in some kind of a pattern and then look for a signal, right? And in this case, right around 10 or 11 in the morning, okay, it had formed a nice sideways channel there and gave us a nice support level there, represented by the blue line. And the trade on this is to short when it breaks that blue line, right? And then as soon as it does break that blue line, that support level, then you'd put your stop, your initial stop, right at the red line there, where I say set stop here. And then you can just trend trade it through the rest of the day. And in this example, it would have worked beautifully. All right. So this is the gap and crap, and it is the most common type of gap. Okay. So remember, I've told you that when you're trading, you want to come up with a small portfolio of strategies that you do every day. This is one you can put in your toolbox, right? You look for stocks that are gapping up or gapping down, right? And then you fade it. You look to trade it in the opposite direction. Let them set up and let them give you a sell signal. Or if you want to go along, stock gaps down and give you a buy signal. So gap and craps are very effective trading techniques. So you might want to include this in your little bag of tricks when it comes to trading. So those are the 3 types of gaps. Okay, so I hope you found this fun. Please give this video a like. Please subscribe if you haven't. I would love to get a comment from you. So Edward Anderson signing out.
Copy that.